Ladies and gentlemen, good day and welcome to Q4 FY22 earnings conference call of Can Fin Homes Limited, hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touch-tone phone. Please.
Operator request has been initiated. If you'd like to cancel this request, please press star 0 again.
Please note that this conference is being recorded. I now hand the conference over to Mr. Nitesh Jain from Investec Capital Services. Thank you, and over to you, sir.
Thank you, Ryan. Good afternoon, everyone. Welcome to the Q4 FY22 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us today Mr. Girish Kousgi, MD and CEO Can Fin Homes, Mr. Amitabh Chatterjee, Deputy Managing Director, Ms. Shamila, Business Head, and Mr. Prashant Joshi, CFO of Can Fin Homes, along with other members of the management team. I would now like to hand over the call to Mr. Kousgi for his opening comments. Over to you, sir.
Good afternoon to all the investors and welcome to the earnings call of quarter 4. We had a very good quarter, and if you've seen after COVID from October, demand picked up, and quarter 4 of last year we did pretty well. I think we clocked all-time high for most of the parameters. And since we had dropped rates, I think we had some impact in terms of spread and NIM for some time. And then quarter 1 of this year, there was an issue because of COVID second wave. After that, I think the next 3 quarters have been pretty good. So in last 4 quarters have been very good. I think all-time high. Sequentially, every quarter, we've been doing pretty well. So I think the numbers. And also, I would like to clarify. Today, I was on CNBC. There was some rumor about my exit. So I've categorically clarified that I am with the company and I have not resigned. I don't intend to move out. I think I've made it very, very clear. And there is also some rumor about the audit. So we had an audit from NHP, and that is not complete. So we have the discussion next week, and nothing abnormal has come out till now. And this apart, we also keep having regular audits, and nothing abnormal has come out. Whatever we have found is in the normal course of business. Now, coming back to quarter 4, I think quarter 4 was really good for us because it was all-time high disbursement in the history ever, both in terms of disbursements and also in terms of book growth. NIM was 4.15. Last quarter was 3.74. Last quarter, it included 9 bits because of LCR investments. And this time, because of LCR investment, it is about 12 bits. So net of that would be 4.03. That's the NIM. And the spread improved to 2.55 from 2.49. So I think all the parameters we have shown good performance. And last year we had provided for COVID about 87 crores at one point in time as a peak. So since we started, I had told you about the trend reversal of margin, because whenever we drop rates, that will have lag effect. And after a couple of quarters, you will see margins shrinking because the entire portfolio will get repriced, and therefore there will be some pressure on margins. But from April, in last year, we had increased rates twice. So that had a positive impact, and therefore we saw spread increasing and NIMs increasing. So I had told that quarter 4 is the time where everything will be back to steady state, and I think quarter 4 that has really worked out to be all the parameters in line with what I had mentioned earlier. In terms of cost of funds, there was slight increase in cost because rates started moving up in last quarter. However, even our yields went up, and therefore we were able to increase our spread to 2.55. So incremental cost has gone up slightly. At a portfolio level, our cost of funds is 5.56, and incrementally it is 5.03. and incremental yield is 8.07 and portfolio yield is 8.11. In terms of asset quality, I think we've been seeing NPA levels coming down. At one point in time, it was almost close to, yield NPA was close to about 1%. Then we saw 0.91 to 0.9 to 0.78 to 0.71 to 0.64. So as of last quarter end, our NPA was 0.64. Net NPA, which was 0.61, has come down to about 0.3% now. Our PCR, which was 33.47, I think over a period of quarters, we have now increased to about 52.69%. In terms of book growth, I think we've clocked close to about 21%. In terms of book disbursement if I have to compare the whole year, it's about 90% growth over the previous year, and if it is YOY Q4, then it is 35%. In terms of liability mix, nothing much has changed. I think the CP share has come down to about 11%. NCD, we raised a lot of funds last year because it was a mandate. Whatever incremental borrowings we do, 25% will have to come by way of NCD. So NCD share went up to 14%. Deposits remained at 2%. NHB 22 and banks 51. So in Q4, we raised 3,215 crores. In terms of liquidity, we are holding about close to 4,300 crores. These are bank sanctions, which we have not availed. In terms of portfolio mix, HL is 90, non-home loan is 10%. In non-HL, top-up is 4, LAP is 4, and site loan is 1%, and others is about 1%. So totally it comes to about 100. In terms of profile mix, salaried is 72, SNP is 28 at a portfolio level. SNP incrementally had come down to about 12%. I think over a period of time, I think the confidence came back, and we could see a lot of demand coming back, economic activity improving. So now SNP has come back to about 28%. In terms of the ticket size, not much of change. More than 50 lakhs, we have about 3% of the portfolio. We significantly increased our other income, and that is also one reason why our NIM went up. We are focusing on insurance income. So that I think quarter on quarter that is increasing. As far as the focus is on affordable housing. I think that is where we've seen success in the past many years, and that we will continue to do in future. I'll be open for any questions.
Hi, Ryan. Can you open the floor for Q&A?
Sure. We will now begin the question and answer session. Anyone who wishes to ask a question may press star 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shripal Doshi with Equirus. Please proceed.
Hello, sir. Thank you for giving the opportunity, and congratulations for great set of numbers. So my question was with respect to the growth that we have delivered during this quarter. So any particular geography or states that we are seeing the demand is relatively strong?
I had mentioned this earlier also. So I think across the country, all geographies we are getting good demand. Only thing is we had slightly slowed down in NCR, Delhi NCR region. So I think that is continuing. Otherwise, we are seeing good demand from Karnataka, TN, Andhra, Telangana, that is South, Maharashtra, Gujarat, and MP and other places. So only in Delhi NCR it is slightly low. I think, but for that region, we are seeing demand from all other regions.
And so is it in line with our thought process to, relatively grow in the non-south geographies? So is the growth momentum that we are getting, is it in line with that thought process?
But definitely, yes. Even today, we are present in 22 states. Right. Only thing is the concentration on south is slightly more because that has helped us. Even our salary is quite high. It's about now 72%. Right. So we are open as long as we are able to build quality book. So we are open to increase our share in other regions as well. But as it is now, I think I could see maybe 65 and 35, 65 from south and 35 from other regions.
Got it. The second question was with respect to the increase in provisions during the quarter. So if you look at the coverage that we are having, so last quarter it was 45%, and this quarter we've inched that up to almost 53%. So why, at 45% it was probably at a comfortable level. Why this thought process of increasing the provision buffers?
See, what happened was actually last year during COVID, we had provided close to about 87 crores. So that we had utilized in the subsequent quarters. And there was a reversal in the margins, and now you could see that now it is back to steady state. And we have made good, I think we have done overall performance is pretty good. And so we thought, let's, because we are not very sure about COVID fourth wave. And we thought so that when we are doing well, let's, create some amount as provision so that, we might take a call in future. I think that's the idea, because whatever we had created last year, I think everything was utilized in the subsequent quarters.
Got it. And the absolute GNPA number has come off. So have we seen some resolution, or is it more of upgrade?
No, basically upgradation is very low, to be very honest with you. But what we have done is from the NPA pool we have resolved. If you look at last 1 year, the GNPA number, which was about 200 crores, has now come down to almost about 170 crores. So this is because of two things. One is there have been some additions, but there has been more recovery from the NPA pool. So overall, NPA has come down. It was 0.71 in Q3. It has come down to 0.64.
So is it because from the resolution such as surface invocation would have got smoothly incorporated, is it?
Exactly, it is basically surface action, OTS, and very few reversals, from NPA, which is early buckets, to regular. Because now after the new guideline, RBI guideline, we had to collect all the EMIs, what is overdue.
Right. Okay, so thank you so much. I'll come in the queue for more questions. Thank you, and good luck for the next quarters.
Thank you.
Thank you. Our next question is from Abhijit V with Sundaram Mutual Fund. Please go ahead.
Sir, thank you for taking my question. Congratulations on very strong set of numbers. First question, sir, I just wanted to follow up on Sripal's question. Has there been any change in LGD calculation, sir? Because PCR, you have taken it up to 50%. I understand that you want to have cushion, but how is the LGD behaving for the portfolio?
There is no change at all.
Yeah. Okay. What will be the LGD, sir, for the portfolio? Hello?
Yeah, please go ahead and come back. I'll just tell you the exact numbers.
Okay, sure. And follow-up question, sir, is what will be the excess provisions you are holding, which is outside PCR and outside standard asset requirement? Do you still have any cushion, like you mentioned that 87 crores which you had during COVID time? Do you still hold any cushion apart from PCR and standard asset provision?
No, we are not holding any provision. Only the 15 crores what we provided this quarter. That is the only addition. Otherwise, rest all is either NPA or standard asset or restructured pools. Restructured provisioning, we are holding about 67 crores, and standard asset is about 98 crores, and the rest is for NPA. So LGD, for stage 1 is 0.33, stage 2 is 0.76 and 0.17. Point 33, 18 and 79, stage 1, 2 and 3. That's the breakup.
Brian, can we take the next question, please?
Yes. So our next question is from Rahul Maheshwari with Ambit Asset Management. Please proceed.
Good afternoon. Am I audible?
Yes, you're audible. Please go ahead.
Yeah. Thank you so much for the opportunity and fantastic delivery for the quarter. My 3 questions. First, on the for the entire year, if you look at the kind of OPEX growth that is taking place, and that is common phenomena for the entire banking industry, can we expect the same run rate of OPEX growth that would be taking place, and what are the levers that will be that will lead to the such higher OPEX growth for the upcoming year? Can you give some color on that? That is the first question. Second question, as in last quarter we had witnessed that the balance transfer out just dropped to just 78 crores, and new normal, which you guided that it would be in the range of 100 crores. So what is the current quarter's balance transfer out, and going forward, how you see the scenario? And the third question was on branches. Can you throw that the branch productivity currently, which shows in terms of the business and in terms of the employees, is at optimum level, or how far we can gain the productivity in terms of the branches, so that we can come to know that what is the scope of branch addition that would be taking place from the going perspective. These are my 3 questions. Thank you so much.
So on the BT, if you look at last year was 543 crores, and for the year which just went by, it is 293. So it has drastically come down. So as I had mentioned in my earlier calls also, BT has come down because we were able to put in a strong team to retain customers, and we had an aggressive customer retention strategy. And in terms of potential, with respect to either employees or the branches, I think we still have scope. I think it's a continuous process because we constantly work on branch productivity and employee productivity, and therefore we feel that, for example, if you look at Q3, the average business per employee was 27.6 crores, which improved 29.97 crores in Q4. And average business per branch was 127 crores. Now it's improved to 136 crores. So I think there is enough and more scope to work on efficiency at branches and also at employee level. With respect to OPEX, I think cost control, cost optimization is a continuous effort, and we are working on that since last 2 years, and this effort will continue. So it will be in line with the business as well, but yes, it will be under check.
So just a follow up on this, can we expect the OPEX growth in line with the revenue growth that will be taking place? And also on branches, let me keep it in this way, that out of the 187 branches, how many branches are that where you find the productivity, or there is a scope of, in terms of the old vintage, where there is a higher scope of the productivity go to 136 crores, which is showing on an average basis. So that we will come to whether there is a serious branch expansion needed, because as earlier also you have guided just a branch expansion of 15, 16 branches you will be adding on. So if you can throw some light, it would be very helpful. That's why when the markets are strong.
So obviously, my revenue growth has to be higher than the OPEX growth. So that is something which will always manage. But having said that, as we are working on the entire IT infrastructure, and therefore that will be one component in OPEX. And number two, when you try to do more business, you have to hire people as well. So employee cost also would increase in that proportion. Yes. And number three, CSR. So that's a normal spend every year. So our OPEX also would increase in same line, but maybe slightly lesser than the revenue increase. Yes. And also, when we do more business, one is employee cost, because we need to hire employees, and number two, we have to also pay DSA commission. So it will be in line with that. With respect to branch expansion, as I mentioned, because of COVID, we had planned for 6 branches, and in next 12 to 14 months, we'll be opening another 10 to 12 branches.
Okay. Thank you so much. I'll come back in queue, and best wishes. Thank you.
Sure. Thank you.
Thank you. Our next question is from Nitin Jain, who's an individual investor. Please proceed with your question.
Yeah, thank you for the opportunity. And first of all, congratulations on a great set of numbers. Sir, on one of your slides, you have spoken about digital transformation within the company. So it's not quite clear as to what initiatives have been taken. So if you could, list out like say, the top 3 initiatives, that would be very helpful. And also in one of your media interviews, you mentioned that the NIMs are expected to cool off. So like going forward, we are expected to see the central bank to increase rates. So do you see NIMs cooling off because of your cost of funds going up or increased competition? If you could clarify. Thank you. These are my 2 questions.
So as a company, we are working on more of automation and less of digitalization. I think both are used, So only thing is, for a product like home loan, we work on automation. So this is in terms of, one, we are changing the entire IT infrastructure in terms of entire systems, lending, then deposit, everything we are changing. So we are now strengthening our IT infrastructure. And number 2, we will integrate with various APIs to try and do faster decisioning. So this will be used for front end, for sourcing, and also for collection. So overall, and also we'll work on scan-based approval, and we'll use intelligence to try and decision. So before someone could actually eyeball and then take a decision. So basically, it's a part of digitalization and to a large extent automation, which will be our UAT, so that we can try and crash the TAT.
Okay. So just to follow up on that, sir, if you could,
Yeah. In terms of NIM, so in fact earlier I used to say that for a profile like Canfin, spread of 2.4 and NIM of 3, but yes, we are seeing that NIM is inching up quarter on quarter, and now it is 4.15. That's also because of some support from LCR investments. So this is because we have drastically increased our other income. So on a steady state, I mentioned. So it's not that next quarter NIM is going to drop substantially. What I meant was on a steady state, spread will be around 2.5 and NIM will be about 3.75. So now it is 4.15. So if we have opportunity, definitely we will always try and keep at that level, or maybe slightly increase as well. But on a steady state, I think NIM would be in the range of 3.7 to 3.75.
Great. So just to follow up on the digital transformation, so is it possible to provide any numbers in terms of what is the benefit you are seeing in terms of sourcing or operational efficiency because of the automation?
It's for example, now we are using Profios. Now earlier, to analyze one self-employed balance sheet, we were taking about 2 hours. So now we take 3 minutes. right? So now, if you see the overall TATs, the processing TAT will come down by at least 50%. I'll not be able to, quantify in terms of number of man hours saved or number of people, number of people reduction, but definitely yes, in the long run, definitely it will give us a lot of value add. And as of now, we are in the process of transformation, IT transformation. It will take about 12 to 15 months time. So we are trying to rework on the entire IT infrastructure.
Okay, that is very helpful, sir. Thank you.
Thank you. Our next question is from Devansh Nigotia from SMIPL. Please proceed.
Yeah, sir. Thanks for the opportunity. Sir, if you can just help us understand how is the restructured book behaving, and out of the provision for standard assets, how much of that would be towards the restructured book?
Restructured book provisioning is about 67 crores. Now, from the total restructured book, 42 crores it has come down. That means these customers have either repaid or basically repaid, right? And out of whatever EMIs have fallen due, as of now the collection is 100%. And what we have written back this quarter is about 1.69 crores from the provision amount.
Okay. That's very helpful. And I'm just a little confused. We mentioned that incremental NIMs are at 3.75.
No, 4.15.
Incremental NIMs.
No. NIM is 4.15. I told going forward on a steady state, NIM should settle around 3.75.
Okay. And what is our outlook on the credit cost for the next year?
See, as of now it is 0.4. So it will be at that level only.
Okay, 0.4% for the full year.
Yeah.
Okay, but if you look at in comparison to our pre-COVID levels, isn't that at a very elevated level? I'm just trying to understand where is this elevated credit cost coming from? Because our mix between salaried and non-salaried is still the same. So
no, earlier it was 0.36. Earlier it was 0.36. Now it is 0.4. Our PCR is increasing, so that's the effect.
Okay. That's it from my side. Thank you.
Thank you. Our next question is from the line of Umang Shah with Kotak Mutual Fund. Please proceed.
Yeah, hi. Congratulations on a good quarter and thanks for taking my question. One is on our liability mix. If you could just help me, what is the residual maturity of our commercial papers?
See, commercial papers maximum is 1 year, so it will be on a rolling basis. So we take CP starting from 3 months right up to 1 year. So it will be on a rolling basis. Only thing is, in quarter 4 we reduced CP, which was about 16% to about 11%. Our peak was 19%. We brought it down to 11%, and LCD went up because we had to use LCD for last year based on the incremental borrowing.
Sure. And sir, the second question was regarding the capital raising exercise. So, if I recall correctly, in the previous quarter you had mentioned that at some point you might look at an option to raise equity capital in the current fiscal. Any plans that you have formed up around those lines?
Yeah, we will raise capital. We have enabling approval from shareholders to raise up to 1,000 crores. So we will raise a part of that amount in next 2 to 3 quarters time. We will raise.
Okay, understood. And sir, last data point, what is our outstanding restructured book as on March 22?
It's about 676 crores.
676 crores, and we are carrying 67 crores of provisions around it.
Yeah, 10% of that, yeah.
Okay. All right. Thank you so much and good luck for future quarters.
Thank you.
Thank you. Our next question is from the line of Maruk Ajania with Edelweiss. Please proceed.
Hello, sir. Congratulations.
Thank you.
I had a couple of questions. My first question is, what was your incremental cost of funds during the quarter in Q4, and any feelers on what it is in 1Q so far?
Incremental cost of funds was 5.03 and at portfolio was 5.56. So I think in next quarter or two, rates will inch up. So we feel that in next 1.5 years time, rates might go up by 100 bips to 125 bips.
Got it. And so the other question was that what is your average ticket size now?
21 lakhs.
And what was it last quarter?
No, it was, it used to be 18 lakhs earlier, then it went up to about 21 lakhs, so it's quite stable at that level.
It's stable, okay, because I was just wondering what gave the uptake in NII other than cost of funds this quarter. So, if your ticket size has reduced, if you have gone more affordable.
No, ticket size has not reduced. Okay, our rates have increased because we increased rates twice from April. So the yields have gone up.
Right. And so the insurance income that you get, that's booked where?
That is for the quarter was 6 crores.
How much?
6 crores.
6 crore, okay, and that would be part of NII or other income?
It will be, no, it is other income, but part of NIM.
Part of NIM? Okay, got it, sir. And what was it last quarter?
It was some 3.6 or 3.7 crores.
Okay, sir. Okay. Okay, sir. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Ankush Agarwal with Surge Capital. Please proceed.
Hi, sir. Thank you for taking my question, and congrats on a great quarter. So again, on this NIM, so if I check our Q4 of last year versus Q4 of this year, our spreads are actually lower, right? But our NIMs have still expanded. So based on what we have told till now, obviously there's some effect of the LCR investment and then the insurance income. But still, the NIM is slightly higher. So can you just explain a little bit on what's affecting this?
See, last year, other income was quite low compared to this year, number one. Number two, last year the yields were higher and we had dropped rates and we again increased rates. So the increase you have done is much lower than the drop what we did last year. Therefore you will see the difference.
Right, but the spreads is like 2.78% versus 2.55 this quarter.
Exactly, correct.
Right. And so this insurance income, do you believe this will be a sustaining number and it will grow from here, or is like more of a one-off thing?
No, it will grow from here because it is directly linked to the disbursement growth. So as long as we grow disbursement, even this income also will grow.
Okay, so it's like it's part of, like, it's a product that you're selling with your home loans.
For us, it's a bundled product, yeah.
Okay, it's a bundled product. Got it.
Yeah.
Got it. Secondly, sir, again on the capital raise, you mentioned 2,000 crores is the approval that you have, right?
1,000 crores.
1,000 crores, right. So any specific quantum that you might be looking to raise?
We have not decided, but it will be part of 1,000 crores, not the entire amount. And then the first tranche, it will be part of 1,000 crores.
Right. But you will do it in multiple tranches, is that?
No, what I'm saying is as a first tranche, we will not raise entire 1,000. So we will look at some amount part of 1,000 in next 2 to 3 quarters.
Okay. Got it. And so lastly on the OPEX, so for the last 3-4 quarters, the OPEX, the cost to income ratio is increased constantly to now close to 20%, right? So what are your thoughts in the medium to long term? Would it start trending lower to the pre-COVID levels of 15%, or how is it?
You're talking about cost to income or OPEX? Cost to income.
Yeah.
Cost to income will be around 17 to 18% on a steady state. See, now we are investing on so many things. right? And therefore you will see that cost income slightly higher. I think it will get moderated.
Okay. So this IT transformation that you're doing, that would not help much in reducing the cost.
No, initially, obviously, we have to spend. I think over a period it will start helping.
Okay. Thank you. So lastly, just again, one feedback that I gave last quarter as well. I mean, it would be very helpful, if you can increase some levels of disclosure on presentation, the basic metrics of average book, average borrowing or average equity. Even if these three metrics are available, it would be very helpful.
Okay, sure.
Thank you.
Thank you. Our next question is from the line of Shweta Tarapdar with Elara Capital. Please go ahead.
Thank you, sir. Congratulations on the quarter. So a couple of questions from my side. So last time I remember you mentioned that your CP has been on the higher side because of NIM management. So now that you have multiple levers on NIM accretion, so where do you see the CP mix going? Will it go down further, or there is some ceiling which internally you have decided that you would not surpass the same?
We have a limit of 4,000 crores. Okay. So as of now, it is 11%. So we will see, depending on the need, it will be about 15-16%. Is where we will try to stabilize, because that is only for managing cost. So it is not for funding purpose. And in quarter 4, we had the need to raise NCDs, and therefore CP share went down and NCD shares went up. And this would continue in a few quarters from now as well. So we will try and balance so that we keep our cost low. At the same time, comply on the NCD requirement, what is required, to be raised depending on the incremental borrowing in the year.
Understood. So in terms of disbursement, so each quarter you've been surpassing the previous quarter level, and you've put up historically high number each quarter. So where do you see this number settling down once the pent-up demand sort of settles? So is it going to go beyond 27 billion, or how is it like?
See, it's a going concern. Demand is quite robust. So I think every quarter we'll try to put up best performance compared to the previous quarter. So let's see where it ends up.
Sure. So last question from my side. So a couple of quarters ago, you had also highlighted the aspirations to move into higher ticket size. So what is the thought process there? What is the strategy? Like, are we sort of already getting there directionally? And I always wondered, why this sort of decision, especially in a market which is also seeing competitive intensities flaring from the bank side as well. Thank you.
Yeah, what we were doing probably few quarters back, and now there has been slight improvement. That is why you'll see our ticket size also going up to 21 lakhs, which was 18 lakhs earlier. I think from now onwards, there is less scope for us to increase ticket size, so it will be around 21, 22 lakhs going forward as well. So that is where we will stabilize.
Sure, thank you.
Thank you. Our next question is from the line of Meeti Gupta with IIFL. Please go ahead.
Yeah, hi sir. Congratulations for the good numbers.
Thank
I
you.
just wanted to know that whether the NPA numbers is including the IRAC norm numbers or it's excluding those numbers.
It's IRAC only.
It's IRAC only?
Yeah.
Okay. Thank you.
Thank you. Our next question is from the line of Pawan Kumar with Ratnatra Cap. Please go ahead.
Sir, our spread guidance is going forward would be around 2.5%, is it, sir? That's what I heard.
Spread, yes, you're right.
Okay. And what are the kind of growth rates that we should expect in FY23?
18-20.
As per the conditions now?
18-20%.
Okay. And due to this stamping duty cuts being rolled back in some states, would that affect our growth rates?
Not much. No, not much. Demand is quite robust, so 18-20% growth is very much achievable. So it won't impact.
Okay. And any reasons why you expect the spreads to actually roll back as of now?
See, earlier, we were managing spread of a slightly higher number, and when COVID started, we had a lot of competition from banks, and therefore we had to drop rates. So the entire portfolio has repriced, and now even today, as we speak, I think home loan rates available in the market is quite low. It's in the range of 7 to 7.5%. Right? So if you have to be competitive, and it's more of a balance between profitability and growth. And that is the reason, why we have slightly moderated on the spread.
Okay. And on the incremental capital that you plan to raise, have you decided on how much you want to raise? No.
No, not yet.
Okay. Fine, sir. Thank you.
Thank you. Our next question is from the line of Manoj Oberoi with Yes Securities. Please go ahead.
Yeah, sir. Hi, this is Rajiv here. Thank you for taking my question, and congratulations on strong numbers. Sir, two things. Firstly, in terms of if you can give some, color about how incrementally is our portfolio, changing. So maybe if you can just give more color on the quality of incremental portfolio being onboarded, because we are at a different rate at this point in time. Say when we were about 12 months before, and even pre-COVID in terms of our relative positioning. So then have we kind of slightly, relaxed in terms of customer profile or property profile? If you can just kind of give some flavor about the quality of new portfolio being onboarded at 8.07.
See, actually, we have not changed any policy in last 2.5 years, 3 years, or even the process. We have not changed anything. Now, because of COVID, there were two changes. One, in terms of we had slightly tightened, and we then restored it back, especially for SENP, and this happened long back. So we had done this for about 6 to 7 months time, and effectively this happened in only 3 to 4 months time. Right. So as of now, I think there is no change at all. What happened where due to COVID, SENP, which was 30%, incrementally also had come down to about 12%. So now that is back to about almost 28 odd percent. So I think a quarter or two it will be back to again 70% salaried and 30% self-employed. This is on the profile side. In terms of product, we have increased non-home, which was 9% to about 10% in last few quarters. So these two are the.
Sir, maybe within, say, salaried and within self-employed risk categories, have you seen any shift or any change out there within self-employed and salaried? And second level could be also in terms of, say, property profiles. So has the kind of incrementally property profile slightly changing in our portfolio?
Not really.
Okay.
We've not seen no changes.
Got it. And sir, one last thing was again a rumor that.
Only thing is the demand from self-employed came down because of COVID, and now slowly it is coming back. So otherwise we have not seen any change.
Yeah. And sir, one more rumor that I wanted to clarify on, because we've been hearing that some people have been kind of deputed or have joined from Canara Bank at the operational level. So is this true? And if they've come, then what roles will be playing, and how should we read this?
So basically, I think there have been 3 people from Canara Bank. So one would be part of risk team, assisting the risk team, and the second person has joined the audit team, will be supporting the audit head and audit team. The third person will be in HR and other administration. So 3 people have joined from Canara Bank, yes, on deputation.
Okay, and they are for a long-term assignment, or they've just come for a short stint?
So they just came a couple of months back, and generally when they come, their term is for 3 years.
Got it, sir. Okay. Thank you so much for answering my question.
Thank you. Our next question is from the line of Tejas Mehta with Omkara Capital. Please go ahead.
Hi. Thanks for taking my question, sir. Just a few questions. One is, can you give us a sense what is the quantum of the portfolio in and around Bangalore?
Bangalore, see, I'll tell you incrementally, Bangalore does about 23-24% of the business.
Yeah, and on the book?
Book will be about 25.5%, which used to be 33%, few quarters back.
Yeah. Correct. So just wanted to check.
Because now dependency on Karnataka has come down because other regions are contributing well, like Telangana, AP, then Tamil Nadu, Rajasthan, Maharashtra, they're all contributing. Earlier, the dependency on Karnataka was almost 1/3, so now it has come down. Actually, it started coming down more than 15 months back only.
Got it. So can you help me understand this movement of cost this time in the P&L? Like employee costs dropped on a QOQ basis, but then there was a very sharp jump in other operating costs. What's the reason for that?
No, see, if you look at the employee, it's basically, one is new hiring. Actually, it's not come down, it's gone up. One is new hiring, and second is, the increment, what they got. If you're talking about the whole year. Otherwise, OpEx has gone up because of our IT spend. Second is CSR, and third is DSA commission because we are increasing our disbursement. So in line with disbursement, even the DSA commission also will increase.
Yeah, because cost shot up to 193 crores, which on a QOQ basis, it's like what, from 84 crores. So that is like 110 crore increase in the cost. We didn't understand that. How can it such a massive cost increase happen in just one quarter?
See, I'll give you the breakup. See, actually, we did salary revision, which happens once in 5 years, and that call we took little late, and therefore we had to pay the arrears also. So I think this was clarified earlier, but again we'll be able to give you a breakup on that.
Right. Even employee cost, it is actually stable at 180 to 88 crores. Last quarter it went up to 214, and now it is again come down. So, all right, I'll later on reach out to you personally to get the breakup.
Yeah, sure.
You got it. So on the capital adequacy, what's the capital adequacy that we have today?
So as of now, it is 23.3%.
And tier 1?
I think major except 100% everything is tier 1.
So 23.3%, if that is the capital adequacy, then why do we need to raise more equity then?
It's a good question. Yeah, I think the only reason why we are contemplating is because of DER.
Because of what?
DER, debt equity ratio.
Okay, but you don't really look at debt equity ratio in this kind of business.
I understand. We've been engaging with all the bankers, so obviously, we also were pretty comfortable, DER of up to 8.5 times, and therefore, we also had a backup plan. One is, if you look at capital adequacy, we are at a comfortable level. But we thought of raising capital, thinking in mind that one, it will help us to be future ready in terms of growth, and number two, also to try and bring down DER.
Yeah, because the thing is that if you say issue 500 to 600 crores of capital, and you are on 3,000 crores of equity today, so that's like 20% dilution on the equity, and on the market cap, of course, it will look lower. But on the current equity, it will look much larger. So basically, existing equity investors will actually kind of suffer because the ROEs will drop. And as well as, so there are other things as well. So, I'm not able to understand why they need to raise equity.
That's the reason why, we've been talking about this for last few quarters. That's the reason why, we had deferred. So whenever we raise, there will be some impact on ROE for that particular year. And from next year, I think it will enable to improve the ratios. So that this is true for any company at any given point in time whenever they're going for equity raise. So I think that is inbuilt. I think we look at all the numbers before we take a decision.
Got it. And for next year, can we expect a 10,000 crore plus kind of disbursement number, FY23?
Yes, you can expect.
Okay. All right, great. Thank you so much.
Thank you. Our next question is from the line of Chandrasekhar Sridhar with Fidelity International. Please go ahead.
Hi, sir, can you tell what's the LCR at this point in time?
Sorry, come again?
What is the LCR at this point in time?
I didn't get you. LCR?
Yes.
386 crores. See, the requirement is about 350 crores, but we are holding more than 1,000 crores.
Okay. And what is the drag on NIMs? You said
No, there is no drag. It's a positive carry as of now, which is why I told that 4.15% NIM is not sustainable because today the rates are favorable. It may not. As of now, we are holding more because it's helping us. And also the rates are fluctuating. So as of now, it's a positive carry. And therefore, out of 4.15, 12 bits is because of LCR investments.
Okay. Can you just remind me why are you guiding to 40 bits of credit cost next year? What's the logic behind it? Especially given where asset quality is so good.
No, I'm only saying that. See, we are pretty confident of the restructured book and the book what we are building. I'm only saying that there won't be much changes. As of now, it is 0.4. It will continue at 0.4. Maybe there could be 1 or 2 weeks here and there, plus minus.
Yeah, but that's still much higher than the history. And we've already passed the COVID wave. They've done that. We've managed reasonably well. So I'm just trying to understand the logic of having 40 bips when historically we've been at anywhere between 15 to 20 bips.
See, the PCR today, what it is 53%, maybe going forward it will slightly come down because we should do the balancing act. So from 0.36 it went up to 0.4 credit cost. PCR, which is about 33, now it is about 53. So PCR going forward will come down because as of now you just created, right? Going forward we might draw that. And I said 0.4 because currently it's 0.4 and there won't be much change in that. Maybe if at all there is a change, it will be by 1 bip or 2 bips.
So is this, are our LGD estimates now higher than what we've had historically?
In terms of credit cost?
Yes.
Not really. No, nothing has changed. See, even today, I think 0.4 is quite low, very low actually.
No, absolutely. I'm just saying versus our own history, it's still higher. We used to run maybe 15, 20 bits. Just trying to understand the logic of.
No, at that point in time, the portfolio had not matured. Now we are seeing a matured portfolio, and over a period of time, it has settled down between 0.35 to 0.4.
Right. Can you help us? What's the stage 2 number as of the end of the year?
Stage 2 number, just a minute. ₹1,270 crores stage 2.
Okay. Thank you very much.
Thank you.
Thank you. Our next question is from the line of Abhijit Tibrewal with Motilal Oswal. Please go ahead.
Thanks a lot. So a couple of data keeping questions. Firstly, I joined the call a little late, so please excuse me if some of these are repetitions. So what's the stock of your borrowing number as at the end of the quarter?
I did mention this in quarter 4. We borrowed. This is a minute. ₹5,000 crores. Incremental borrowing is 5,000 crores.
Yes, sir. So you mentioned that in your opening remarks. I was asking what's the stock today?
as of March 31st? What is the outstanding borrowings that's there?
24,600. 24,600.
Great, sir. Thank you. So secondly, I mean, somewhere during the call you mentioned that other than 67 crores of OTR provisions, you are carrying about 90 crores of NPL provisions and around 116 crores of standard asset provisions. So will it then be fair to say that the total ECL provisions that we are holding today is about 273 crores?
See, today what we're holding is totally 270 crores of provisioning. 98 crores is standard assets. Then NPA is about 90 crores. Then restructured pool is about 68 crores. And additional is 15. Total is 270.
270?
Yeah.
All right. And sir, I mean, sometime back to the previous participant, you mentioned the stage 2 number, which was about 1270 crores. What is the provision that you're carrying on the stage 2?
On stage 2, we are carrying 34.88.
Okay. So sir, would it then be fair to say that, I mean, large part of the increase that you're seeing, or rather that 40 bits of credit cost that you're guiding for, is partly driven by the fact that you now want to increase the provision cover on your standard loans, given that you suggested that PCR on stage 3 will incrementally come down?
Yeah, partly right. And also, if you see, when we are growing the book, our provisioning on standard also goes up.
Right. So the other question that I had is, I mean, you had suggested during this call itself that you will increase the interest rate by about, I think 2 times during the course of the last year. And if I recall from our past earning calls, you suggested that there is an annual reset on the interest rate that you do. So are you kind of running a risk that, given that there will be an annual reset on some of the customers that you would have probably lent at lower rates about a year back, there could be higher, balance transfer requests going forward?
No, it's a balancing act. Yes, that do happen. But, to manage that, we will probably drop rates or, keep the card rate lower. So it's a balancing act. At the end of the day, we need to work on the yield spread, right, and the cost of funds. So it's more of a balancing act.
All right. So just one last question here on your liability mix. So, obviously the CP has declined to about 11% in this quarter. And like you explained earlier, sir, that this was to do with the fact that there's a requirement to borrow in the form of NCTs, a proportion of your incremental borrowings in the quarter. But then you subsequently also suggested that you would be looking to maintain CPs at around 15% of the liability mix. Don't you think, given that, a lot of questions, I'm sure in all investor interactions as well, hover around the fact that you're running a higher proportion of CPs in your liability mix. Don't you think, it will be, better if you kind of maintain CP at maybe these levels rather than looking to increase it back to about 15-16% levels in the next year? And sir, probably one more question here is that, to the earlier participant, maybe you guided for disbursements of about 10,000 crores, if I recall correctly. So just wanted to understand, I'm seeing that our branch network has been fairly constant for a long amount of time, for the last at least 3-4 years. So sir, what is leading to this better disbursements? Because typically it's either better distribution, deeper penetration, or improvement in efficiency that enables, lenders to, scale up their disbursement. What is it that our secret sauce here, sir?
Okay. So in terms of CP is not for funding. CP is only used as a tool for cost leveraging. So, if you see a couple of years back, CP was very, very high. So now we brought it down. And what happens is that we need to also manage the cost, right? And therefore, we will definitely use CP as a tool to ensure that the cost remains low. and there is no risk because CP will be only against backup, which means sanctioned term loan limit which is undrawn, or against available OD limit. So to that extent, CP of 14, 15 or 16%, I don't think so. It's a risk because it is not for funding purpose. In terms of disbursement, if you look at the growth from last year to this year, I think the growth is not very substantial. It will be about some 20-odd%, and that is the guidance what we have given as well. And I also mentioned that we are opening branches, and we will open branches this year as well. Only thing is, due to COVID, the pace of opening branches came down, and therefore, if you see in last 2 years, not too many branches are open. Now, having said that, we are also working on deeper penetration and working on employee productivity. So there we feel that enough scope is there, and we can take our book to close to about 40,000 crores with the existing set of branches. Having said that, we will also open branches and try to increase contribution from the new branches as well.
Right, sir. Thank you so much. This is very, very useful, and I wish your team the very best.
Thank you so much.
Thank you. Our next question is from the line of Viraj Gandhi with Semco Mutual Funds. Please go ahead.
Yeah, hi. Thank you very much for taking my question. Most of the questions are answered. Just one final clarification from my side. You started this call saying that the NHB audit is going on. Just wanted to clarify or comment on that. Is it not a special audit and only a general audit which happens with most of the housing finance companies?
NHB, they do two types of audit. One is on the, which is central system audit, and second is credit audit. So one audit is over, and that discussion is pending, and another audit is yet to start. This happens every year. And this apart, there will be internal audits, which will be happening. I think the special audit what you're referring to is the internal audit. So this happens on a continuous basis.
Okay. And from the provisions that we have made this quarter, there is nothing allocated for this particular audit, correct?
See, whatever observations we have received so far are general in nature and in the normal course of business.
That's more than important. Thank you.
Thank you. Our next question is from the line of Gaurav Jani with Prabhudas Lilladher. Please go ahead.
Thank you, sir. Congrats on a good set of numbers. Just clarification first. Firstly, the investment income, the impact on margins versus 12 basis points. Could it be safe to assume it will be about 8 crore on the NII?
It's about, for the quarter, it's about 18 crores.
18 crore. Okay. And that is on the NII, right? Not the interest income. The net effect is what you're saying.
NII only.
Okay. Got it. So secondly, the NPA numbers that we have mentioned this time around, so have you reverted back to the previous recognition, or this is basically daily NPA recognition?
See, rolling back to current, if you're talking about that, I think that is very, very less. This is basically through legal action and SARFAESI and OTS from the NPA pool. There have been some flow from SMA2 to NPA, but the recovery is much higher, and therefore the NPA has come down from 0.71 to 0.64.
Sir, what I wanted to ask you is the 0.64% is basis the daily NPA recognition, or is it as per the previous deadlines?
This is as per the new regulation only. See, November 12th RBI circular said two things. One is NPA tagging. NPA tagging has to happen on the 90th day. So earlier, every month was taken as 1 month. For example, in a month, let's say, for example, if you take quarter one, so quarter one, Jan is 31, April is 30, May is 31, and June is 30. So it is more than 90. Right. So NPA recognition has to be on the 90th day, and we should not go by, month-wise. That's number one. Number two, once the account becomes NPA, earlier we could have upgraded. Suppose, let's say, an NPA account, if you receive 2 EMIs, account could have come to SMA2. But now we have to collect 4 EMIs, so that from NPA it will directly come, it will become current. So these two are the changes. Now this 0.64 is as per the new guideline.
Okay. Yeah, sure. Because there was a relaxation, so that's why I thought of asking, but thanks for the detailed answer.
So this we implemented from that month only, from November of last year.
Sure. Got it. Sir, coming back to the provisioning guidance number of about 40 basis points. So, could you sort of say that we are being a bit more conservative out here? Because frankly, assuming a 20% growth on a sort of a 40 basis point standard provisioning, we are looking at 20 odd crores, and we already have a 50 odd plus % of a PCR. So, I just want your thoughts on that. Or are we being much more conservative out here?
Maybe you are right. We will try and moderate this looking at a couple of more quarters.
Sure. Got that. Sir, also just 2 more questions from my end. One is the repayment rate for the quarter per se seems a bit elevated, although obviously the disbursements were pretty strong. But on an annualized basis, it was about 20%. So anything to read out here? Suddenly did the comparative intensity go up from banks or other HFCs? Or how should we sort of look at it?
No, for 2021 it was 543 crores, and 21-22 it came down to 293 crores. So what peak we saw, out of this if you take on an average BT out is about 30 odd crores, and this is part payment and foreclosure. All put together it is 293 crores.
Okay. So nothing specific for the quarter, right?
It is normalized. It is back to pre-COVID levels.
Sure. I, sir, missed your answer on the breakup of CET1 and Tier 2. Sorry, so could you repeat that?
Tier 2 is only 100 crores.
Okay, got it. And so finally, the total employees number as on date?
About little over 900.
Okay, got it, sir. Thank you so much. All the best.
Thank you. Our next question is from the line of Ayushi Shah with Affluence Shares and Stocks. Please go ahead.
Hello.
Yes, please go ahead, ma'am.
So my question is slightly on the macro level. So I think everyone here is aware of the fact that the company is like one of the greatest beneficiaries of increasing demand in the affordable housing segment. So what I would like to know is like the hindrances or the problems you feel that the company is facing, especially in increasing disbursements to the various geographies that we have. And so how are we dealing with the increasing competition in the segment? Because like the company had previously adopted like a low interest rate strategy to like protect its market share. But do you think it is sustainable? And if not, what are the other methods that they're adopting?
Actually, competition was there always. Only thing is during COVID time, because there was certain constraint on mobility of people, and therefore business was not coming through, and therefore a lot of banks became aggressive on BT, and therefore there was heightened activity of BT. So competition was much higher than what it used to be. Now from January onwards, it is back to normal. So from January, competition is back to normal, which is business as usual for us. So it's almost I think 5 quarters now. So we are not we do have competition. We are able to manage that. So the competition what was there in COVID 2 quarters and what we see now, there is a huge difference. At that point in time, there was huge competition. Now competition has come back to normal level, and therefore the kind of growth what we are looking at is quite possible.
Okay, sir. And are we looking at like any new products that we can launch in order to like improve the spread that we have going forward?
We'll have to think about it, but yes, if there's an opportunity, we'll definitely look at it.
Okay, sir. Thank you.
Thank you. Our next question is from the line of Gaurav Kochar with Mirae Asset. Please go ahead.
Good evening, sir. Thanks for taking my question. Sir, sorry for persisting on this, but the credit cost guidance of 40 bips, if I look at FY21 and 22, the 2 years of COVID, our credit cost was sub 30 bips in each of these years. And even if I look at the net NPL number, it's 30 basis points, so nothing much to talk about. So what's underlining this, 40 basis point guidance? Are you seeing anything, on the credit cost side or on asset quality side that you believe maybe the restructured book or the stage 2 assets, which is leading you to guide for a 40 basis sort of credit cost? Because
No, not at all. For all we know, this 40 bps will come down. Because we have increased the PCR, so it will have its impact. So we are not seeing impact from the restructured book. 42 crores, the book has come down by 42 crores already. And out of the EMIs which have fallen due, I think all the accounts are regular. So we don't see, initially I had mentioned out of the restructured pool, about 7% might flow to NPA, which is about 49 crores. So I think there is no change in the plan. Probably that number could be much lower than what we had anticipated earlier. So this 40 bps can further come down.
Sure. So this 40 basis point is only a conservative number, and based on experience in COVID, I mean, one can easily assume that credit cost should be 30 basis point or sub 30 basis.
It could come down from 40 basis.
Okay, sure. And sir, sorry, this has been answered earlier. You mentioned that there is an NHB audit going on, but any other investigation internally or by an outsider done in the last quarter or so, apart from the NHB audit that you're talking about?
So, basically, I'll tell you what, these kind of audits keep happening. So, whenever there is a complaint, obviously the audit happens. So, in that audit also, nothing has come out which is other than what comes out in the normal course of business. What has actually come out is some kind of irregularity in one branch, which is Bilwara. So there we have identified about 3.93 crores of fraud. When I say fraud, it's irregularity, where the income tax IT returns were fake. So this happens at any given point in time during any audit, across any branch. So this is what has come down. This is what has come up. Apart from this, there is nothing which is abnormal which has come up.
Okay, so this audit was conducted by your own internal team, is it?
We do regular audit, every quarter, in fact, every month, every quarter, because it's more of a concurrent kind of audit what we keep doing across the country. So this is a regular exercise.
Okay, understood. Sure, sir. Got it. And so last question on margins. When you say the spreads will go down to 2.5 and margin on a sustainable basis 3.7, is it more to do with funding costs moving up, or you believe yields could also be under pressure, given that currently at marginal yield of 8.07? Do you see that as a risk, or your funding cost at 5.5 that as a risk when you say the spreads will come down?
See, yield will go up, cost also will go up. So we will protect margins what we have mentioned. It is basically a balance between profitability and growth. If you have to grow at that level, we need to take slight hit on the margins, and therefore I said 2.5 spread and about 3.75 NIM would look as appropriate in the steady state of business.
Okay, understood. You're saying 18 to 20% growth. In order to maintain that, maybe some bit of margin compression might happen in the next year.
Correct, yeah.
Okay, sure. Perfect. All the very best. Thank you.
Thank you. Our next question is from the line of Dhaval Gada with DSP. Please go ahead.
Yeah, hi sir. Congrats on good set of numbers. I just had one question on the insurance attachment. So where would we be on the insurance attachment in FY22 compared to, let's say, pre-COVID, and your expectation for next year?
No, we are also looking at some 20% growth in the insurance income.
In terms of attachment rate, it would be like 50% attached, or higher or lower, any qualitative or quantitative number if you could provide?
See, insurance is something, which is optional to the customer, right? And therefore, we will, on a best effort basis, we'll try to grow at about 20%. So because we track based on value penetration, and for certain products on number penetration, so we will try to grow at about 20%.
And the value penetration is more than 50%?
No, both 20% only.
20%, okay, fine. Okay, thanks. All the best.
Thank you.
Thank you. Our next question is from the line of Franklin Moraes with Equentis Wealth Advisory. Please go ahead.
Yeah, thanks for taking my question. So I just wanted to confirm that, the volatility in rates that we had seen in the past year or so, and even, the borrowing mix wherein the CP was increased and then reduced. So this kind of volatility is not likely to, or it's likely to moderate going forward, right?
See, in terms of the liability mix, I think this is quite normal for us. What we saw abnormal in last 2 years is only COVID. So other than COVID, everything else for us is quite normal. So the CP fluctuation also is well within the limit.
So this 10 to 20% range of that CP fluctuation, we can assume that similar kind of range happening in going forward, right?
We will keep it at 15% plus or minus 2%.
Okay. Okay, fine. And what is your average tenure of the book, both on origination and on closing out of the loan?
So average is about 8.5, 9 years. On origination, it will be about 20 years. On if you look at the average loan on book, it's about 8.5 to 9 years.
Okay. And what is the average LTV?
Average LTV at a portfolio level is about 67%.
Sorry?
67% on portfolio.
67%. So is there some scope to increase this LTV, or we are happy with the current level?
It depends on the need of the customer. So if there is a need, we'll increase by 1% or 2%. Otherwise, we'll go with the flow. As of now, it was 65, now it is 67. So we will keep at that level unless and until there is a need.
Okay. Thanks a lot.
Thank you.
Thank you. Our next question is from the line of Meeti Gupta with IIFL. Please go ahead.
Sir, can you please confirm me the numbers for stage 1, 2, and 3 for this quarter?
Just a minute. So stage 1 is what is it? Stage 1 is 25,268. Stage 2 is 1,270. Stage 3 is 170.
35268 is for stage 1.
Come again? 1270. That's stage 2.
Okay, and stage 3?
Stage 3 is 170.
Okay, sure. Thank you.
Thank you.
Thank you. Our next question is from the line of Manoj Oberoi with Yes Securities. Please go ahead.
Yes, sir, just one number. I wanted a stage 2 number for December quarter, for the previous quarter ending.
I'll come back to you. Just give me some time.
Okay, sir. Yeah. Yeah, that's it from my side.
Thank you. Our next question is from the line of Gaurav Jani with Prabhudas Lilladher. Please go ahead.
So quick questions. Thanks again. One is incrementally, what will be the cost of CP versus NCD for you?
NCD, the last NCD what we raised was at 6.8%, and the CP depends on tenor. 1 year CP comes at about, now it's about 5%.
Okay, sure. That's helpful. So secondly, on the OTR pool, basically the restructured pool. So, now how should we look at FY23 and 24? I mean, how much of it will become due in 23 and 24 and so on?
So this year about 10% would become due, but we are seeing increase, closures happening in the restructured pool.
Okay, sure. Got it. So lastly, just a number, the total risk-weighted asset number, please.
Sorry, come again, which number?
The risk-weighted assets number, please, as on date. Hello?
I'll just tell you what is the blended. Just a minute. It's about 50%.
50% of the cruising area, you mean?
Yeah, book.
Okay. Got it. Thank you so much, sir. That's it.
Thank you. Our next question is from the line of Ratik Gupta with Guardian AMC. Please go ahead.
My questions have been answered. Thank you.
Thank you.
In December, stage 2 numbers are 1,652.
That was the last question for the day. I would now like to hand the conference over to Mr. Girish Kousgi, MD and CEO, for closing comments.
Thank you, all the investors. We look forward to your same support in the future also. Thank you so much.
The person you are speaking with.
On behalf of Investec Capital Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.